Hey everybody, it's Bob again with Phil from Trade Genius. Welcome to our podcast. Normally, Phil and I are the grizzly bears of the market here, but the market's telling us there might be a bit of a thaw here before we have our next cycle down. Stay tuned, we'll talk about it.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, we just can't keep beating this thing down all day long. They sometimes these things are like corks. The Fed throws money at it and the cork comes up to the surface. You want to kind of show some charts and maybe tell the folks what we think might be happening here short term. It could be as little as a week, but I'll let you go ahead and show that chart and show everybody.
Yeah, so here's the chart. And basically, one thing we tell everybody and we show them this chart is that, look, liquidity at the end of the day, liquidity reigns supreme. And so we have this, this big spike in blue. That's the Fed liquidity that we always reference. And so there was a big debate on Twitter and elsewhere about, was this jump up in liquidity actually going to make its way into the markets? All we've ever seen is that pumps the markets. And this was directly because of the banks going to the Fed window, emergency lending window, essentially, and then that new bank lending program and giving them money. And so people were saying, well, it's more of a backstop. It's there to fill the hole. My argument with that is at some point along the way, that liquidity that the banks are suddenly out of transferred somewhere else. So for example, if they bought treasuries that were now underwater, well, somebody sold them those treasuries and received that liquidity. Okay. So for giving them more money to backstop their liquidity hole, you're adding more liquidity into the system. That's the way I look at it. In other words, if you have a hole in the sand at the beach, that sand that was in that hole is somewhere else on the beach, right? But that would be like you coming back in with a truck saying, well, instead of me trying to find that sand, I'm just going to backfill this hole so there's no more holes so nobody falls in. You added more sand to the beach, okay? So when you add more sand to the stock market beach, the stock market goes up. So until this changes and this regime changes, this is what's going to drive everything, okay? So you can debate whether or not they were backstopping the banks and the banks were going to turn around and give that money back to the market. And the end of the day, the net of the net is that it usually makes the market go up. So we go with that until we see otherwise. And so if we look, we can look at these charts here. A couple things we look at. One, this is the breadth line here. We're not at overbought. Usually when we're at overbought is where we start to say, okay, let's be careful. We're not anywhere near that. Fair value is maybe the more important piece of the puzzle. And that isn't anywhere near where we would be worried. So, yes, there's problems under the hood. There's a lot of things that says recession. At the end of the day, the SPX trades very technically, and our technical indicators aren't overbought here. So a lot of you guys have been saying like, you guys are too bearish and you should be more bullish. And like I said in the previous last week's video, we were bullish off these lows because our system said risk on, and it still says risk on. So in the short term, we could certainly go higher. And I've highlighted this line up here, which is actually a gap we left behind earlier last year. We're up at 42.30. So that's where we could end up climaxing this move. Okay, we'd still put it in a lower high, okay, but we would climax this move because one thing the markets don't like is leaving these gaps behind. And so I think ultimately that might be where this move crescendos. Then we might get overbought over here on breadth. Then we might start getting into our short hedge euphoric levels over here on the fair value. We are noticing a little decline in the liquidity. The banks are starting to pull money out of the market. The Fed's been tapering. The last week's tapering was the largest taper they have done in 1 week since they started tapering. So to me, it tells me that the liquidity they added for the banking was a one-time thing. It wasn't like they're changing the whole tapering program. They're still tapering. And Yellen's out of bullets. In fact, that was another thing I wanted to show you guys was this is Yellen's banking account, basically. So Yellen's banking account is getting quickly to zero. Now, that's happened in the past, and this is where we get into the debt ceiling debates, and ultimately debt ceiling gets raised, and then she goes back to issuing debt. The problem when you go back to issuing debt is that takes the net effect of that takes away liquidity from the stock market. Okay. It's a complex system. People need to buy treasuries on a regular basis. They haven't been able to, okay? Because since March or February, she was no longer able to issue new debt. Okay, she can roll existing debt. She can't issue new debt. And the way the world works, everyone buys U.S. treasuries and bonds. That's just the way it is. They need to on a regular basis for a lot of different reasons. And they're going to go back to doing that. And that money is not going to come into the stock market. It's going to go into the treasury market and the bond market. So what we're going to end up with is another situation where we came into 2022. I know this is a little cut off here, but it says 2022. And she went crazy issuing new debt. And we're going to run into the same cycle. This is going to coincide with the second half of the year, which is where we think a lot of the recession indicators that are firing off now are going to manifest. And so I think there's probably, with the market and especially the professional money is that this is the last hurrah to get the market up, and then they can probably take a big fat short position as this thing starts to roll over into the second half of the year. So everything looks pretty bullish. Bitcoin looks bullish, gold looks bullish, silver looks really bullish. The stock market looks bullish, but I think we're on borrowed time here, Bob. And I think that we have a number of things to look at to start spiking up. I think probably the most immediate one to affect the markets will be the Treasury checking account here once that debt ceiling is raised. And that debt ceiling could kick off the highs too. I mean, that could kick off where we start to roll over, because if that debt ceiling starts shutting down the government, shutting down national parks, there's going to be a lot of, I think that's where you're going to start seeing the VIX wake up. Instead of VIX being docile down here under 20, I think that thing's going to start ripping higher, because there's serious ramifications if we default or are unable to pay interest payments. That would send shockwaves throughout the entire bond market globally.
Yeah, I totally agree. And, back to your first point about digging the hole in the beach, that's a great analogy. It goes with the same myth of money on the sidelines. There is no, money is either is or is not. And so the only person that brings money in and out of the market is the banking system creates it, and the banking system destroys it. Otherwise, if I sold my stock to Phil, I got his cash. And so that's the same problem we're having now. And, I know people like Martina Booth is saying, oh, you guys are idiots. You don't know what you're talking about. There's no new. Well, guess what? There is new money supply. It's just that they've tried to create it as basically a zero velocity money supply, but it is money supply. And those banks that are flush now with cash because they got all new deposits, well, they're trying to lend that money out at higher rates now too. So, just because you're constrained doesn't mean everybody's constrained. And there's still the shadow banking system out there. There's people out there, you can't get a 6% loan or a 7% mortgage. There's guys that'll lend you money at 13, 14, and 15% all day long. So, the money's out there, and it's available for people. So, yeah, for sure. And look, gold made an all-time high, which is amazing to me. It's so quietly, it did that work. And we've been long suffering in natural gas. And one of these up moves that we're getting, like we got one today. Usually if you see something moving on Monday and a commodity, you should pay attention. And natural gas made a positive move today, while oil was kind of neutral. So keep an eye on that one. That might be some opportunity for a big move, because seasonally we're waiting for it. The inventories are wiped out, and they got to refill these tanks before next fall and next winter. So that might be the opportunity there. I'm traveling here maybe later in the week. Phil, we can maybe show some commodity charts and see if there's some opportunities in some of these commodities before Friday is all the banking news. This might be a Thursday night, top for the market too, because I think those banking earnings are going to suck.
Yeah, so we have tomorrow is the Fed minutes, and we have some economic data pre-market that's high impact. We have high impact data on Thursday, and then the banking earnings on Friday. So to me, it smells like buy the rumor, sell the news. So we could potentially push up into those bank earnings on Friday. I think the banks have been beaten down pretty sufficiently, but if they sell again, look out below. And that's the other thing too, is you don't normally start bull markets with the banking sector in the hole. They're usually right there with us trying to get out of here. So definitely some headwinds ahead of us, but for the short term, very short term, everything looks good for higher. And like I said, I think if we can start pushing up over 41.50 in the futures going into the next couple of days, that opens us up for that higher target up there to close that SPX gap, which would effectively be about 4250 plus on ES or 4228 on the SPX. So that's kind of what we're looking at here going into the Fed minutes tomorrow.
Yep. Welcome to Alice in Wonderland, folks. Thanks for listening. Hit like, hit subscribe, tell your friends, and let us know what things you want us to talk about. And you can see we're pretty flexible here. You know, see trade, take trade, and we'll worry about macro next week.
All right, guys. Thanks for watching. See you tomorrow.
Trade Genius.